Hello everyone, my name is Michael Lamott. I am the founder of ChartYourTrade.com. Our goal is to inspire millions of hardworking people just like you to take advantage of the stock market. And the way that we're going to do that today is by helping you figure out where to sell your stocks. And one of the ways that I like to manage my stocks and when I'm going to get out is by progressively raising my stop loss. So with that, here's a little presentation that I gave at a meetup last month in October about raising your stops. Enjoy. Alright, in this presentation, we're going to be talking about stop losses, when to set your stop losses, when to push the button, and this is part 2 of the series, and we're going to be talking about raising our stops, knowing when to raise our stops. So in all my live presentations, I give a little bit about me. I'm not going to go into all of it here. You could hit the pause button and read through all of that if you want, but let's just dive right into the material. So when we're setting our stop losses or when we're doing anything in the market, timing is going to be everything. It's absolutely crucial. So we need to know what our time frame is. How are we trading? Are we more of a short-term swing trader where we're going to be looking to buy and hold something for only a couple of days or a couple of weeks most of the time? Are we more intermediate term where our average holding period is going to be several weeks or several months or close to a year? Or are we more of a longer term investor where we're looking to buy and hold something for over a year and possibly even several years? So knowing that when we're going into the trade is going to dictate a lot of where we're going to get in or get out or anything. So on ChartYourTrade, we have an advanced stock reports service, and part of that service offers a model portfolio that everybody's able to follow along with. That model portfolio trades on an intermediate term basis, and one of the stocks that it bought was Alibaba, and so that's why I'm showing you here to kind of give you an example of how we get in and how we set our stop losses and how we move our stop losses up. So we got in back in January, and our stop loss, our initial stop loss was right around here. And the first time that we raised our stop was right after Alibaba made that low there. And the reason why we raised it there was because it made a significant low. It coincides with the 50-day moving average. It was a high volume reversal on earnings, and it has a very long tail. So the tail is a price action term where if you have long price action bar like this, then that's the tail, and this bottom of it is where we would look to place our stop loss, especially when the stock reverses and closes near the high of the day, and it's also coinciding with this 50-day moving average down there. So as the trade progressed, we had that moving average. And another thing that I like to do when I'm looking for where I'm going to place a stop loss is to look at where price stops, but to also see where on the chart it kind of makes sense for it to happen. So it's kind of like seeing what's happening in real time and then looking in the rearview mirror to see, well, why is this action happening right here, right now? So Alibaba formed this little resistance area over here, and then it gapped above that, so that was the next spot where we raised our stop loss to. Then it consolidated, and it came down over here, and then it started to rally and break out, and eventually we raised our stop loss to this level here. The timing of that, we didn't raise it immediately to that level. We let it hang out down here until the 50-day moving average caught up to it. So right around here. So the reason why we like to use the 50-day moving average again is because we're trading from an intermediate term perspective and we're looking to capture the bulk of the move. So when a short-term resistance level or shorter-term support level starts to coincide with the longer-term moving average, the 50-day moving average, that's when we're looking to raise our stop. Over here, Alibaba pulls back in. It tests the 50-day moving average. The 50-day moving average is catching up to that level, but we also see over here, if we look to the left of the chart, that it's coinciding with resistance right over here. So we place our stop loss right below that level and also right below the 50-day moving average. So that way, if price does fall, it's testing multiple levels. It's testing that low. It's testing the 50-day moving average. It's testing this former resistance level that's now becoming support. So a ceiling is now becoming a floor. And it's allowing us to capture the bulk of the move and stay long for the duration. And at the time of this presentation, it had formed this resistance level here, but it hadn't tested it quite yet, so we didn't move our stop up. At this point, our stop is up above 160. So let's talk a little bit about why we even set stop losses. The purpose of setting stop losses is because the way to win in the stock market is to compound our returns over time. If we don't have good stops, then the bigger losses that we have will work against us exponentially. So if we have a 10% stop loss, it's going to take 11% to get back to even. A 15% stop loss will require an 18% gain to get back to even. And this is from the portfolio. So if we have a 15% drawdown, 18% to get back to even. When we start to have 40-50% loss, then it takes, from a 50% drawdown in our portfolio, it takes 100% just to get back to even. How often do we have 100% gain for the whole portfolio? It takes a long time. Even if you're a very good seasoned trader and you have a return, an average return of 20% or 25%, it's going to take you years to come back from a 50% drawdown. That's why having stop losses is so important. So let's just see what this looks like with a $100,000 portfolio to further illustrate this point. So let's say that these are your trades. So if you're trading with a 7.5% stop loss and an average gain of 22.5%, and you had 20 trades, you would have a gains of 3,000. Now, for the sake of this example, I'm having the same amount of winning trades, the same amount of losing trades. The only difference is the amount of the gain and the amount of the loss. And so we have a 30% win rate for each trade. So if this is trader 1, trader 2, trader 3, they each have the same number of trades, the same winning percentage, and the only variable is the average gain. Right? So looking at this, if your average gain is 22.5% and your average loss is 7.5%, after 20 trades, this person ends up with $3,000 gain, and that's great. Then on to trader 2, and their average loss is 5%, and their average gain is 20%. So we cut both of them are cut by 2.5%, right? But this person is able to come out with a $5,000 gain rather than a $3,000 gain. So they're making less money per win, but because their loss is small, they're able to compound faster. Do you see that? I thought like that. This is why it's so important for us to limit our losses and to keep our losses as small as possible, because that's really where the magic happens. That's how compounding happens, and that's why it's so important for us to manage our stops and manage our risk and keep our losses as small as possible. This person over here, I let have some different gains and losses, so more of a real, what you might see in real time. So this person has some gains that are 15%, but the maximum loss is 5%. And so with only 20% gains, and with 15% gains, this person is still able to have the same kind of returns as the person that's having 22.5% gains. So only 20% winners, 15, actually, what was it? It was 4 15% winners, 20% winners, and they were able to come out with the same gains as this person over here that had 22.5% winners, all by just simply keeping that stop just a little bit smaller. So managing risk is crucial. This person's average gain is only $1,666. This person's average gain is $2,250. The biggest average gain is over here with Trader 1. Meanwhile, they have the same gains as Trader 1 and Trader 3. What really matters is managing risk. Can't stress that enough, in case you haven't noticed. So a few points on this. We always need to know where we're going to get out of a trade before we even enter the trade. We want to cut losses as fast as we possibly can, because that's what's going to allow us to compound over time. And to win, we have to stay in the game a long time, and by cutting our losses short, it's going to prevent those massive drawdowns. And so that's crucial. And finally, we need to let our winners compound. The only way to achieve that is not to take these big losses. So setting stop losses. 3 main things for setting stop losses. We need to identify our support levels. We need to watch how your stock acts around key moving averages. Is it respecting the 50-day moving average? Is it ignoring it? The moving averages that I like to look at are the 10, the 21, the 50, the 100, and the 200-day moving averages. And we also want to look at the distance between our entry and our exit point, because if it's too wide, it might not be worth it for us to even consider the trade. Here's a trade that we also took in January, Adobe. And what we see here is pulled off of investors.com. It shows what the rating is. It shows some fundamental data on that site that you could get for free. Fantastic resource, fantastic free resource that you don't even need to create an account. You could just get this stuff on investors.com. Yeah, you could see the earnings, the float, IPO date. You could see Pretty sure they have short interest somewhere. You could see the sector, the industry group rank, so many things that you could find out about an individual stock. And so here's Adobe, and we got in right over here in the model portfolio. The space was 12% deep, and so our entry point from entry to exit was only 2.5%. So that's something that allowed us to really have a larger position while only risking the same amount. We only like to risk 1% of our existing capital on any one trade, and so having a tighter entry and exit point allowed us to leverage this position. Now, in some trading methodologies, you'll see a blanket sell at between 7 to 8%. So at 7.5%, this is where your stop loss would land you, way down here at almost the 200-day moving average. In my opinion, that's pretty unnecessary, even if unless you're a long-term trader and you're using this as your entry point. For an intermediate term and definitely a shorter term trader, having a stop loss that far down is just not necessary on this trade, because you have the shorter term support level building right around there at the 21-day moving average, and it coincides with former resistance, and it's been tested twice. So all things that you like to look at when you're seeing these kinds of support levels build. So Adobe broke out, it ran quite a bit, and then the first time that we are really raising our stop at all on this trade was really once this floor was established over here. So we raise our stops to break even once we start to see gain, so that way everything else is gravy in the account. But we want to let the stocks run for as long as they can, and we'll raise our stops progressively as support builds. The first time that support is really building on an intermediate term level isn't until we get to over here. We have this gap up after Adobe reported earnings, and then it ran up, and then it comes down and it tests the 50-day moving average, and coincidentally it's just above this high when it catches that 50-day moving average. So then we raise our stops, and we raise them to just below that level, and then it tries to shake us out below the 50-day moving average, but because our stop losses are down here, we don't get shaken out. So this is where your time frame really matters. If you're somebody that got in on this gap up and you're trading more of a shorter time frame, then you're probably selling bits and pieces into strength, and you're probably exiting quite a bit on this day if you are that shorter term swing trader. If you are a long-term trader, then you're probably not even raising your stop. You might have your stop loss over here, but I'm thinking that you're probably following more of the 200-day moving average versus even considering the 50-day moving average, because the 50-day is still more of an intermediate term place to get out of a trade. Adobe picks up, it starts to test the 50-day moving average over here, and you can see how it's coinciding with this former high over here in that resistance level. It tried to poke its nose above it there, it failed immediately, and then it's just kind of like chopping around, and then it's building this floor right around the 144 level, and it's now coinciding with that 50-day moving average. And so when it finally does start to break out above there, then this becomes the new floor. So timing is crucial, right? Like we didn't raise our stop up to this level until this 144 was tested multiple times and Adobe started to rally above resistance over here. That's the trigger to raise your stop. When your support level is established and you begin to rally above a fresh resistance level, then raise your stop, and again have it coincide with a moving average, particularly the 50-day moving average, because that's where institutions typically step in and support their stock. So the stop loss needs to make sense technically, and not just because we work with a 7 to 8% stop loss within this CAN-SLIM methodology. For those of you that don't know what CAN-SLIM is, it's part of this book here, How to Make Money in Stocks by William O'Neill. Fantastic book, one of the books that I read early on when I first started trading, and it really is a great foundation. I recommend it to everybody. But we don't want to just have an arbitrary 7 to 8% stop loss. That just doesn't work. It needs to make sense on the chart as well. So let's reverse engineer why we even want a 7 to 8% stop loss. In order to win in the stock market, we typically want to have a 3-to-1 reward to risk ratio on every single trade that we're going to take. This allows us to have a really low batting average, only a 250 batting average. So if we're trading 10 times, then that means that we're only winning every 2 to 3 times, right? So we're not winning that much. We don't need to win that much in order to break even or to win just a little bit. Most stocks, when they break out of real consolidations, they're going to run between 20 to 25%. That's what it's been historically. That's what the research shows in here, and that's what I've seen in my own trading experience as well. And that's when they break out from a classic pivot point. So, well, we'll have another video about consolidations and classic pivots and different patterns, but typically when a stock breaks out of a consolidation that's 5 or 6 weeks long, if it's going to work, it'll run 20 to 25% and then base out again. So what does this give us, right? So reverse engineering from the 20 to 25%, and having the 7 to 8% stop loss, it's giving us basically that 3-to-1 reward to risk in both cases. So 3 times 7 is going to give us a 21% gain. 3 times 8 gives us a 24% gain. So 20 to 25%, take your gains. 7 to 8% cut your losses, and you have your 3-to-1 reward to risk. So some of the challenges in CAN-SLIM and why the book is fantastic and I love it, but in order to get to the next level, there's a few things that we want to consider. So what does a successful breakout look like? The price closes above the pivot point on volume that is a minimum of 40% above average, ideally closing near the highs of the day. Now that's fantastic, but that's going to put us out of position from where our stop loss will be. So if we buy at a little bit above that pivot point and we use a 7 to 8% stop loss, it's not really considering how that looks technically on the chart. Where is support? Well, it doesn't matter. It's just 7 to 8%, right? So that's one of the big challenges in the Cancelim world. Doesn't consider the stop placement. Could buy slightly extended in relation to support. And this also is going to dramatically narrow our buying opportunities if we're waiting to the end of the day to buy a stock to see if it has the volume. So part of what I like to consider when I'm buying a stock is I always like to identify where I'm going to get out of a stock before I get into the stock. So I'm looking at the pivot point, and I'm looking for advanced entry points, but I'm also looking at where is support, because that's what's going to dictate the position size, like I mentioned earlier, of the trade. And so if we have our entry point here and we plan on exiting here, then we'll be able to have a much larger position and potentially gain a lot more than if we enter here but our exit point is way down here. So what I like to do is identify entry points that are close to support and close to moving averages. I like to have both because that's really going to solidify that exit point, and it's going to really be a breakdown of the chart. I want the chart to be proving me wrong on the trade versus just having some kind of an arbitrary thing. So the more negatives that we could line up for reasons why we're going to exit, the better. And the tighter the distance between the entry and the exit point, the easier it's going to be for us to compound. And just like how compounding, when we have losses, works against us, when we have gains, it's going to work for us. So keeping our losses small, keeping our gains large, that's what's going to allow us to ultimately win in the stock market, and do that again and again and again and again. And even when we have these smaller gains, it's going to allow us to dramatically outperform. And lastly, you're a winner, baby. So get out there and do it. Thank you all so much for watching. I truly, truly appreciate it. I know that was a little bit of a complicated topic, so if you have any questions at all, please leave them in the comment section below and I will personally help you. And you'll also be helping out a lot of other people, because a lot of other people probably have the same kind of questions that you do as well. If you like the video, give it a little thumbs up. That helps us a lot. And also make sure that you subscribe to the channel so that way you get all of our updates. Thanks again for watching, and I will see you again in the next video. Take care and have a great day.